You're in the Business Insurance Zone with me, Steve Savant, national financial columnist and money-colored commentator. This week on the Biz Premium Financing Series, and on today's show, basic and advanced planning with premium financing with Bruce Haydu, and in the second half, Rick Veit, right here on the Business Insurance Zone.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant. We're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And by the way, it is America's largest fountain. There was a little debate on the web a couple days ago, and I clarified all that. And I want to welcome back day 3, Bruce Haydu. Bruce, how you doing?
Thank you very much.
You surviving our show?
It's fun.
I got to say, listen, if you're coming to this show today, right, and you haven't seen Monday and Tuesday show, I ask you, you need to pause this video and actually go to Monday and Tuesday. We're actually doing building block thinking here, and it really will help your educational process if you go back and watch it in succession. So watch Monday and Tuesday, because today we're kind of going deep on this. We're going to talk about basic planning ideas with premium financing. Now, some of this I got traditional. Some of this was kind of new even for me, and I'm a 30-year veteran, and I'm thinking, if I didn't know this, how many other producers didn't know it? Let's talk about the obvious one and then transition into some of the other ones. Estate planning, that I get. Talk about that.
Well, estate planning means you're trying to avoid the large estate tax, or at least offset that so you can leave your money to your heirs. And people use life insurance predominantly to do that. And our program fits the bill because they can get all the life insurance they need if they meet the requirements of net worth and income with the high probability of no cost. So it's, again, posting collateral, getting the coverage they need, putting permanent policies in place.
I'm not using the annual gift.
You're
right?
not using the annual.
Right.
You can.
You could, but you don't have to.
Of course. It depends on your net worth, but yes, you can use the annual gift in conjunction with this, but it's not part of it.
Well, I think everybody sees that that's a traditional. They've seen premium financing and estate planning. But what about buy-sell agreements? Now we're into succession business planning. I mean, that's a little different. Does it matter if it's buy-sell, cross-purchase, stock redemption, or wait-and-see trust? Does it really matter?
All of the above.
So in business succession now, we're actually using premium financing to take care of ongoing business issues on continuation plans.
Right. Again, without the cost, or with the high probability of no cost or very little cost in order to put these large policies in place. And when we're talking about the premium finance life insurance program, as we have been, it's a large policy. It's at least $10 million. We have another program for smaller policies. However, this one, it requires a large business value for this type of coverage. What
do you think is the demarcation line on that? What's your minimum value?
Well, the 15 million of net revenue is my demarcation. You want to see a company that's worth 30 or 40 million. You want to see partners who need at least 10 million to be bought out so that their families can carry on without them supporting them.
I also noticed you had key man or key person. You have an exec that's maybe a rainmaker in your organization, and you really want to do something to carve him out and do something non-discriminatory, right?
Right.
So I'm looking at key man funding. And is it usually for an income scenario, or could it be morbidity benefits like LTC or disability?
Well, yes, and it's interesting.
Was that yes to all three?
It can be. We're not on that program yet. That is a derivation of what we've been talking about the last few days, but we will go there in detail. But in terms of income and key people, we have a major Fortune 500 corporation who had 10 key people making about $1 million each, average age 50. So they took out 10 $10 million policies on each person. And after the loan exit, which was scheduled to occur in 15 years, after the corporation was paying no premiums.
I'm assuming when you say 15 years, you're targeting age 65 somewhere in that vicinity?
Yes, and it was designed as a golden handcuffs. In other words, you get these benefits, guys, if you stay with us until retirement. If they did, they not only got to keep their $10 million death benefit, but they were able to withdraw $350,000 tax-free per year beginning at age 66 for the rest of their lives.
And the bank's already paid off and out of the whole entire plan.
Income does not start until the bank is paid off, correct.
Well, that's a huge, what a freeing up of capital issue, and especially right now with the economy starting to move off the floor, I've noticed a lot of headhunters out looking for new execs, and one of the issues of keeping them or retaining great employees and rainmakers in your organization is to have the huge executive benefits, and now I can give a benefit without coming out of pocket. I love all that.
Right.
Now, I've noticed, before we got on this, I want to just touch on this, that Dynasty Trusts were so hot over the last decade. I mean, very hot, but I noticed that they've kind of taken a little kind of a sidestep or a sidebar. I'm wondering, how can I revitalize those? Because I saw a tactic you talked about that seems to be able to do that.
Well, I think with the downturn in investment returns, trusts are not earning as much as they were, yet they're still distributing to the beneficiaries, and the trust therefore are being diluted. So what we can do is take the premium finance life insurance program, pick 20 beneficiaries of the trust from ages 35 to 65, put 10 or 20 million on each life, finance all policies under one loan, and as they mature and pass on 20, 30, 40 years down the road, all of that death benefit flows back into the trust, revitalizes it for future generations.
Now, I just looked at it, I looked at 2 or 3 that I was involved myself, and I'm thinking, there is going to become a D-Day when I have exhausted all those benefits, and now we're talking about being able to come back in to a Dynasty Trust, which is on the verge of exhausting all its funds, and revitalize and refund the entire amount based on premium financing.
That's right.
Yeah, to me, this is why this is a flex. This is way greater than what we did when we first got into premium financing back in the days of 1999. So we're really looking at different financial planning applications that can really build out your practice. When we come back, we're going to explore some of the more advanced planning strategies with premium financing with Bruce Haydu, and of course, our attorney back again today, Rick Veit. And don't forget, you can enroll in IULUniversity.com for the best education and sales support when it comes to life insurance.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savan. I'm here with Bruce Haydu and Rick Veit, and we're talking about premium financing. But before you do that, I want you to go out to our site, thebiz.tv, and look at all our chart toppers that are out there. Fantastic material, unbelievable giveaways, and some really carrier expose information that you're going to really appreciate. And just a heads up, before moving forward with anything that we talk about on this show, especially this week, always talk to your tax advisor, and if you're FINRA licensed, your broker-dealer compliance department. We explored in the first segment with Bruce, we were talking about basic ideas. Now I have Rick on, and of course, when we go in advance, we better have an attorney on here just to cover our back door. So let's talk about this. This is a really hot idea that you guys have come up with. I mean, I don't know if you're the inventors of it, but you're one of the people that are really one of the fresh faces out on the web and some of the white papers and publications that you put out on multi-generational planning with premium financing.
Well, I'll start it off and then hand it off to the attorney. This is using the basic chassis of premium finance life insurance that we use, the program. And instead of insuring the Generation 1 older matriarch and patriarch, maybe they're above age 70, maybe they're too sick, maybe they can't get insurance. We will insure their children, their 50, 60-year-old children, and or their grandchildren, as long as there's a family lineage. And that relationship will all be financed through our program. And then there's a special legal tool called an intrafamily partnership arrangement that allows Generation 1 to take a very large tax deduction. So Generation 1 gets the deduction, passes more money to Generation 2. They're insured with our insurance, and when they pass on, all that money goes to Generation 3. Generation 3 may also be insured under the same structure, and that money continues to flow downhill. Rick?
Yeah, the key in that arrangement is that Generation 1 is guaranteeing the loan against the policy that's providing, the bank's providing the policies for Generation 2's coverage. So basically, Generation 1 is getting credit for, or a deduction against their estate tax return for that loan guarantee, if you will, the intrafamily loan agreement Bruce discussed. So we're getting coverage in place for future generations. We're reducing the taxable estate of grandma and grandpa. And these are benefits that can literally flow through to Generation 3, Generation 4. And it's probably one of the most popular uses of premium finance life insurance in the country right now, because for better or for worse, a lot of these people have put off their estate planning until it's literally too late. Illnesses can come upon you suddenly. Your ability to get insurance can disappear literally overnight. So if you've waited too long, this is sort of a last resort, and it works very well. We have legal support, we have tax support for all of the components within this particular use of the program.
And of course, the high probability of no cost, just the use of collateral.
When we think about this, is this it seems, even though the idea of multi-generational planning is not new, but incorporating 3 generations using premium financing is unique. So when I'm thinking about multi-families and the spread between first generation and the third, and maybe the fourth, we just worked on a case that had 4 generations. When we see the expansion of human mortality and the timeline expanding, there's a lot that we can do for perpetuity. Well, maybe not perpetuity, but for a very, very long time. For a long time. And do you think this is a new niche, multi-generation? Just the whole idea is we're doing multi-generational planning. Is that becoming a new kind of a new area of estate planning? It
is, because there are more families worth $40 million or more, which is the minimum required net worth for Generation 1 in order to implement this structure. So it is becoming more relevant.
And this is not a dynasty trust, right, Rick, what we're talking about?
No, no. And I just wanted to mention that something estate planners see a lot is that you'll have a family business that's doing very well. The patriarch started it, and usually the second generation takes it. But by the time the third or fourth generation rolls around, that business is either underwater or there's no interest on the part of those generations. So this is another way to secure business succession among 3 or more generations. Because normally, by the time the third or fourth generation has the ability to take over the business, there's minimal interest, there's minimal skill, they're off doing something else, and these family businesses often go by the wayside because of lack of planning, lack of interest.
What about charitable giving? You have another unique take on people who are benevolent, who have a heart for their charity of their choice, IRS approved, of course. What about premium financing and charities? Are the carriers okay with this? Are the charities okay with this?
That's an interesting question. I would focus on the donors of the charities as opposed to the charities themselves. We really haven't had much success with charitable owned insurance, so we've set that aside for a later day. But if you go back to the donor and say, you know, the charity could say, look, you've been faithful all these years, put away your checkbook. We would like to do something for you and your family. And the donor could simply implement a program, 20, 30, 40 million, and leave the majority of that tax-free death benefit to the family, but remember the charity for 10, 20, 30%. On occasion, we have the donor remembering the charity for 100%. So that's a whole niche that needs to be examined, and we have a solution to building these endowments that's never been looked at before.
Well, that's huge. When you think about expanding premium financing, all this week we're talking about so many applications. We're just adding multi-generation and now charitable events. This, to me, is huge to build out your practice and really position your practice to be a unique provider of deep information. Don't forget, you can watch our show and hop out to our website. Just click on the red on-demand button. That's the buzz on the biz for today. Get in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.